Guys, there is a stock market crash looming, and so the news tells us. And as you can tell, oh my gosh, excuse me. And that idea is kind of scaring the bejesus out of me. And I know it's all part of the investing cycle, but words like stock market bubble, about to pop, make me a little bit jumpy. And so I wanted to explore the stock market bubble in a little bit more detail, if only for my own sanity. And perhaps through this process, I can remind myself, and you guys too, that the stock market volatility and vernacular like crash and boom and pops are all part of the process, and we should buckle up for those short-term hiccups. But the question is this hiccup going to make me throw up? So let's sprinkle the facts and find out. So everyone agrees, well, kind of most people agree, that the US stock market is overvalued. I've covered this in another video where I've discussed how analysts are using the CAPE ratio to understand how overvalued the market actually is. So if you want to see that video, you can click right here and it'll take you there. But even when stock markets are overvalued, there are still deals to be had, guys. And even when the US stock market is overvalued, there are still opportunities elsewhere in the world. So in my own case, I've been banging on about how cheap the UK is relative to the world. However, the US, no question, is expensive by any benchmark. It's quite scary the multiples investors are in the US are actually prepared to pay. And when we look at it like that, it's quite scary that historical precedent would indicate the next crash is going to really hurt. Again, some investors argue about how important the valuation metric actually is, or if you're kind of in my camp, or we believe there's a good reason why overvaluation has been allowed to go as far as it has. It's obviously the cost of capital. That is, interest rates are so low that the businesses can invest in growth cheaply. I have to say it is a double-edged sword. With interest rates being so rubbish, there is disproportionate investing in equities, as it's seen as the only viable alternative unless you want to plow into Bitcoin, but forget that, guys. There's also the argument that companies are also less capital intensive than the olden days. The pandemic has exacerbated that, with many businesses now being more dependent on online revenue models. There is also that final point that the whole market is overvalued. So the story goes, we hear it every year, and so investors become skeptical about it as they miss them returns by sitting on the sidelines. Now, with all that being said and done, there has been some research from US investment manager Richard Bernstein, who has been commenting on the markets for a really long time. Now, Bernstein was quite bearish in the run-up to the 2008 crash, as were other managers like Michael Burry, for instance. But the interesting aspect of Bernstein's analysis is that the commentary for the markets has always been bullish since 2008 up until now. So this is really interesting because they were right about 2008 and sensing something was about to go wrong. What is it that Bernstein has picked up that we can glean from their analysis? Well, Bernstein argues that there are 5 characteristics to look for when we are in bubble. Valuation, or how expensive a market, is not one of the indicators we should be looking at, but instead we should look at factors where speculation is pervading the financial society, and that's what's happening now and what would lead to a stock market crash. Now, if you want to go Mystic Meg, what are the 5 indicators we should be looking for? First of all, increased liquidity. Second, increased use of leverage. Democratization of the market. Increased new issues taking advantage of investor appetite to raise money cheaply. And increased turnover. Now, as retail muggle investors, it's hard for us to track these to a level that a professional investor like Bernstein would. But I read articles like the one about Bernstein with great interest, as it gives me a glimpse of what the Illuminati of the financial world are looking at. Also, knowing what these factors are, we can sense if the financial market is behaving like that. And you guessed it, yes it is. Now, leverage is the one that was interested to delve in further, as it's always been an indicator I look at when picking my own stocks. Now, leverage in simple terms is how much debt is used rather than equity to grow a business or investment. So for instance, issuing a bond, taking a loan from a bank, or private enterprise, or other forms of borrowing to help fund business activity. Now, if you have been reading financial press, you will note that private equity has been getting a lot of headlines as companies are being taken private by investors, particularly in the UK, as they're so cheap. So the other side of this is private credit, which is non-banks lending to businesses. This has been booming and for quite some time now. Now, when using leverage to fuel growth, it amplifies returns. So the best example in our lives is when we use mortgages to buy a house. Say you buy a house for 100k with 20% deposit and the property rises to 140k. Then by using an 80% mortgage, you have doubled your down payment if you sold the property now. And that is quite nice when the market is moving upwards. But on the flip side, the market is moving downwards, you're a little bit in the muddy waters. And this is what retail retail investors are currently doing. Bernstein notes that investors are using borrowed capital and leverage instruments like options to capitalize on an upward trending market. Mind blown, I know. And with democratization of investing through apps like Robinhood or 212 in the UK, it drags enough new investors into the market to drive that bubble higher. This is where those meme stocks like GameStop and AMC show how crazy these investment stories can actually be. Then add the booming SPACs and IPOs that we are seeing right now, and that creates a really exciting market where there is added liquidity and changing of stock. So all those 5 boxes are ticked. So the question is, where does that leave us regular investors? Well, it's a tricky situation. Bernstein, and I agree with him, as you can tell from my channel, points to this problem being sector focused, the most at-risk sector being tech. So momentum-based strategies in tech are the riskiest plays of all. I mean, you just have to look at Tesla. Instead, we should look at value plays and neglected sectors, as well as non-US markets as potential areas of return, reminding ourselves that the boring areas of the market are where consistent returns are generated. Lay out the headlines and you'll be fine. And I know that's a little bit tricky to do, especially with the hype and the FOMO. Now, there are 2 videos that go really well with this one. First one is a little bit more detail on CAPE and why that means the US market is overinflated, and it will provide a little bit more context on this. Second video about how I'm allocating more capital right now, which is in the UK stock market. So click here to see those 2 videos and I'll see you over there. See ya.